When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about whether or not retirees are walking into a trap. We'll also talk about what's the real magic number to retire comfortably, and we'll answer listener questions. My name is Jeff Shea. As always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from Jeff Vogan of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. Always fun to be here with you and the listeners, and hopefully we have a good show going.
Well, I know we're going to have a good show today, Jeff. A lot of things to talk about. I'm looking at the headlines this week, and it feels like that retirees are getting hit from all directions. Inflation is creeping back up. Interest rates are staying high. The markets are near highs, but to me, they feel a little bit shaky, but I want to get your opinion on that. Are retirees sort of inadvertently, do you think, walking into a trap right now? It feels that way to me.
Well, I don't know. They're not walking into a trap. I think retirement is a trap if you're not prepared. If you don't have a plan, everything can look like a trap anytime something changes. Every time somebody at the White House speaks, the markets react, good, bad, or indifferent. We had some really solid looking momentum in the oil business, and now we don't. It's kind of weird because a blockade in the Strait of Hormuz and war in Iran doesn't seem to bode well for oil and supplies and things like that. But nevertheless, we're seeing some weakness there. And somehow, I guess, now the war is going to get over because of this blockade. So tech stocks are rebounding. There's no rhyme or reason to market stuff and what's going on as far as the risk goes. I mean, the market, up until just a few days ago was actually down for the year, and now it's back to about break even. Took a big hit. Actually, the first 3 months of the year were not good, and the biggest monthly loss was probably in March. But it's kind of creeping back. Some of that is, unfortunately, it's not the big seven and the Mag 7s and some of the big stocks that drove the market for the last few years. It's been other stocks that have come up. Even small cap stocks have looked like they're getting stronger. Foreign stocks are looking pretty good. And the local market, even though the indexes are going up, still feels a little iffy. Like you said, it's kind of sketchy. And honestly, it's a pretty hard time to be a good stock picker right now. There's a few that continue to surprise us, and there's a few that continue to support our belief that there's still some future in AI and tech and semiconductors and so forth. But there's a lot of stuff that's overvalued. There's a lot of stocks that have a lot of hype that behind them, but no proven earnings and no guarantee that they'll have future earnings. So stock market is even though it's at an all-time high, every crash came after an all-time high. You hear the other side says, like, after every market crash, the market returns to an all-time high. Well, yeah, for the last 100 years, it does always make a new high eventually, but some of those all-time highs took 7 or 8 years. If you look at the 2000 crash and the 2008 crash, in fact, the NASDAQ never made an all-time high for 14 years after it crashed in 2000. So if we are overvalued, we are a little bit worried. Make sure we have some principal protection, make sure we have our income intact, make sure we are saving as much money in taxes so we have a little bit of buffer when the market does correct, so that we have enough cash flow, enough money on the side that we can use in case of an emergency or in case of just living expenses, that we don't have to dip into the market when it's down. I still think we're knocking on the door of a crash. Having said that, our portfolios are up and we're beating the market over the last few years, but we're not doing it with a lot of confidence. We're doing it by just being very vigilant as to where the momentum is and where the money's flowing. And right now it looks a lot manipulated and a lot is just reactionary. I mean, Main Street reacts to whatever's said on the news or out of the White House. Institutions seem like they're still gathering cash and still being defensive, more so now than they were a couple of years ago, which I thought was interesting because, coming off of the 2022 year, I thought the institutions especially would be a little bit more cautious in the face of almost zero earnings until this year. We finally starting to see some earnings, but even those look like they might be short-lived with some of this inflation you mentioned, mostly driven by the cost of oil. The producer price index, we found out this past week, went up around 4%. So that's not a good number. We want it around 2 to 3 max. 2 is our goal, but anything under 3 seems to be okay. The consumer price index still was down in spite of the fact that gas went up. It went up, ticked up a little bit, but not as high as they thought it would be. That was a couple of weeks ago we found that out. But I think, once the producer price index goes up, it definitely filters into the consumer price index, meaning that pocketbooks are going to get squeezed a little bit more at the stores and at the pumps and in our travels, and basically anything that has delivery or shipping associated with it probably is going to be affected by higher oil and thin demand there. So let's see how this war shakes out. Trump keeps giving us hope that it's over, and I think the markets are trying to react and be as positive as they can. Everybody wants to make money in the market, so everybody, I think, wants to be an optimist. The fact is, I've been around long enough to see a few really stinging crashes that hurt people. And a lot of the investors nowadays, I think, in fact, even the majority of investors, I think, are too young to remember that. And the people that are older and retired are either wealthy enough not to worry about it. They might remember, but they think they can ride the storm out again. And a lot of people who are retired didn't have money 20 or 30 years ago when these things were happening, and maybe didn't feel the pinch as bad as they would if they were retired, living on that money, not having a paycheck, having only a Social Security paycheck, and then all of a sudden realizing that these market corrections are pretty devastating. So if people haven't planned and they're nearing retirement or in retirement, they need to take advantage of these new market highs. You never get hurt taking profits and redeploying them into things that protect principal, things that'll still grow if the market continues to have some tailwinds and keep moving ahead. But if we hit a wall, we don't want to have everything at risk and tanking when that happens. And again, it's bound to happen just because history says it will, and history never is wrong. It's just the thing with history is we don't know the dates until we look backwards and find out when they were. So there's still something ahead. Don't know when it'll happen. The market will do it when it wants, and we have to be prepared and not be in a vulnerable position to where all of a sudden we have to try to unretire, go back to work, or change our budgets in order to get through some hard times. But again, if you're wealthy enough, you have enough guaranteed pension monies, and your income is intact, and you're feeling pretty comfortable, then I wouldn't get overly worried about market ups and downs, because that happens. That just is what it is. But again, if you're relying on that money, it's a whole different story.
Jeff, you caught my attention when you said that markets crash after all-time highs usually. Do you think that we're in for a crash, or maybe just an adjustment here sometime in the near future?
Well, we've been having some adjustments. We've had a few in the past few years. They seem to be very short-lived. I mean, the momentum of the market with internet trading and everything from Robinhood to online day-to-day day trading, which most people are doing now, it seems like the momentum can shift pretty quickly. And these little corrections don't seem to be very big deals. They seem to be like, people are calling them dips, but there's a difference between a dip and a downtrend. Some dips are a lower low, then it makes a new high, then it makes a lower high, then it makes a lower low, then a lower high, then a lower low. That's a downtrend, and those aren't dips. But there are some things, I think maybe the gold and silver market's been in a dip. It seems to have bottomed out now. But has it bottomed out? Some of the graphs still show a downtrend, some of it showing on a verge of turning around. But I wouldn't just say, I wouldn't have been buying the dip so much all in a few weeks ago. In fact, most of the market downtrend would say, hey, we're in a downtrend. It's time to take some cover and to be careful. The thing is, things could stay in a downtrend. Could silver go back to $30 or $40 a share? Sure, that could. It was up over 100. Now it's in 70 something. And could it go down? Yeah, there's a lot of things that have made huge gains. Could AI stocks that have doubled and tripled go back to half of the value that they are right now? There's a ton of them that are. Some of them we owned the last couple of years. We got out when they were high because that's always smart to take profits. We're not going to ride those down when they're in a downtrend. If they ever start an uptrend again and they look like they're going to be profitable, we'll get in. But again, you have to look at the market, look at history. And the fact is we have had corrections along the way forever. And we've also had some big market crashes. Anything over 20% is considered a bear market. We haven't had, but just very brief ones, 2 or 3 in the last 5-6 years. But to have a correction, the 50% one, where all of a sudden people are scared out of the market, scared to get back in, and it might take a while to recover. There's a lot of economic factors and a lot of things that we could see are kind of like an everything bubble. There are so many statistics that end in recession that we're just right on the brink of that, and have been for a couple of years now. And I've been saying that, and everybody's saying, well, yeah, Jeff, you've been calling for that for a long time. No, I've just seen the indicators that we're going to have one for a long time. To the extent that we feel comfortable, we can still be in the market trying to take advantage of any upswings, but we also have to be very cautious. We don't know when that final bell is going to ring, when the market's making an all-time high, and it's going to be a downtrend from there. I don't know when that's going to be. Again, we're going to know when it bottoms out, and then all of a sudden it's a year or two behind us when we find out, oh, that really was the bottom of this market cycle. So again, market cycle, most retirees, if they retire in their 60s, will probably go through 3 corrections bigger than a 20% and last longer than a year. A good bear market that makes your gut tickle a little bit, or makes you squirm a little bit, or who knows, makes you break out in hives, whatever, but they're not comfortable. Nobody likes having all their money at risk, shouldn't have all their money at risk. And if you do, then you're either just numb to it because you're super rich and have a lot of income, or you don't realize what it feels like to run out of money. And if you're in a position where you could lock in losses by spending money in a down market, then you need to reevaluate that. And that's a lot of the listeners out there, I'm sure. And there's some that probably are saying, oh, well, I don't care. I've got long-term money and I don't really need my money in the market. Well, great. And that's good. And we have clients that are like that too. And they're not calling me every day the market has a hiccup because they're not worried, because they know that they don't have money in the market they can't afford to wait on because they have other sources of income. But some of the newer clients that saw March take a hiccup, I had a couple of calls last month say, hey, man, is this like normal? Well, no, it is normal because the markets go up and the markets go down. Remember when we made the plan, 2/3 of your money's in a safe place. It's not going down. Just a little bit that you have in the market is. So, and that usually calms people down and say, oh, really? Oh, that's right. That's for my income. I can still get my monthly paychecks and I'm not locking in a loss. And then they go back to feeling comfortable again. But I think there's a lot of people lately. In fact, I know just based on the number since the first, actually February and March, when the market started getting a little hiccupy. In fact, it was pretty much been flat for the last 6 months. If you look at history, or if you look at any chart, it's been pretty flat for the last 6 months. All the indexes have, except the small cap index, which is finally making some headway because it's been forgotten for several years. People have been getting a little bit nervous. I can tell by the tone of their calls when they set appointments and when they first come in. It's, well, yeah, I haven't made money for a while. I'm a little bit worried because I'm using this on a monthly basis. And like you said on the radio, it looks like the balances are going down, not up, and they're not going to go up on the stuff I just spent in the last 6 months. So what should we do? And there are options. And we like to make sure that we explore all those options. Some are tax efficient. Some are very high guaranteed income. Some are principal protected with good upside without necessarily guaranteeing income, but at least guaranteeing against losses. Some of them can even be tax-free, even without a Roth. Roths are tax-free. If you pay the taxes now, you don't have to pay taxes again. LERPs, I like those. They're also a tax-free place to shelter money from the tax man and create income streams that you can predict and count on for the future. But the fact is, a lot of people are assuming we're fine until it's broken, and then they realize, it's too late. And there's other people that are looking at it and say, you know what, it looks like the foundation is getting a little weaker. Maybe there's some risk building here. It looks like these little downstrokes, even though they bounce back, they continue to happen. There doesn't seem to be a new uptrend established, which there isn't. We're just kind of right there at the trying to break into an uptrend, but we really haven't. Every time we get close to the all-time high, we bounce down again. So let's see if that continues to be a trend or if somehow we break out. And then if we break out, then that last 6 months of flatness is going to be a support area. So in other words, we don't want it to go down below those numbers. And if it does, then we might be heading into a downtrend again. If you look at the market every day, if you want to get involved in that, that's how you do it. If you want to delegate that and let somebody else take the worry off your shoulders, then that's what we're here for. And we'll watch that and we'll make sure that we're playing the trends and playing the market smart with your money and our money. I've got the same investments my clients do, and I watch them for myself as well as watch them for the clients. So we're looking at risk. We're keeping all these things we're hearing in the news, all these things you just brought up are definitely top of mind. Every morning when I wake up, 4 or 5 in the morning, I look at pre-market, see what's going on. I read the news, and there's a lot of things that if I were retired and waking up and doing all this stuff, and it was all the money I had riding on the market, I'd be real nervous right now. I'd be probably golfing less and checking out of town a little bit less and staying a little bit close to knowing what's going on, unless I had a plan that it didn't matter. And that's really what we're trying to do, is create a plan so you don't have to worry about it and deal with all the time-consuming mental stress that the market can cause for somebody who's got scared money in the market. We don't want you to have scared money in the market. We want your plan to be intact and not have to worry about all these different things that keep on showing up in the news.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management right here in Tucson, with an office also up in Mesa. And we're talking about whether or not retirees are walking into a trap. If you're within 5 to 10 years of retirement, you're already retired, this is not the time to guess. You need a plan that clearly shows where your income's coming from, how to keep up with inflation, and how it holds up when the markets turn. That's exactly what we're doing here at Premier Retirement with our Premier Retirement Roadmap. We'll show you how to reduce risk, create dependable income, and make sure your money lasts as long as you do. To get your Premier Retirement Roadmap, call 520-780-9059. It's 520-780-9059. You can make that call right now if you want. Leave your name, number. Shelby will call you back during the week and set up that appointment for you. It's 520-780-9059. And you can also find out more about our firm online at premret.com. That's PREMRET.com. Jeff, let's continue this conversation by talking about inflation. We were told that this problem was going away. I mean, we were looking for a 2% inflation rate, but now it's ticking back up. It's around 3% and growing. What do you think is really happening here, and should we be overly worried about this?
Well, I don't know if we should overly worried. I think you need to be prepared for it. The nice part is that bond CD rates are still kind of maintaining that same area so that at least your safe money can keep up with inflation. And I'm surprised that the stock market's been doing as well as it has. Glad, because that's another inflation hedge. Gold and silver, typically not always an inflation hedge. That's just kind of a hit and miss commodity that sometimes goes up, sometimes goes down. But over the last few decades has not necessarily been a great investment, just has been lately. But there are certain things that are inflation hedges. The main thing is, do you have something built in other than Social Security to cover that? Well, there is something that most people have built into a retirement plan, and that is they get a little less busy and a little less crazy about spending money the older they get. So there's kind of a natural fix in place for most retirees when it comes to reasonable inflation. So the 3 or 4% probably isn't going to be devastating. Also, if we build a plan and we are comfortable with the plan, generally it has some buffer in it. Maybe if you're happy living on $100,000 a year, but we have a plan that says you can spend $130,000, inflation is not going to hurt you for 8 or 10 years, even at the current rates. The other thing is, if you're not spending all of it immediately, then you can save some of that and invest. And if investments are doing well and don't crash. Now, by the way, sometimes inflation is a catalyst to make the market crash, because typically in inflationary times, the Fed doesn't lower interest rates. They keep them high, and high interest rates put pressure on companies to borrow money and to invest in their own companies. Maybe they don't put as much money because it's too hard to borrow, and they don't put as much money into infrastructure growth, R&D, and things like that. And so then their stocks end up suffering down the road. We may be seeing some of that in the next few years based on what's been happening with inflation the last 5 or 6 years. We'll see. Sometimes it takes a while to manifest itself, but bonds, if interest rates go up, typically they do with inflation, then bonds go down in value. So if you're selling a bond fund, or if you're buying bond indexes and not holding each bond to maturity because you don't have a laddered bond portfolio. And if you do have a laddered bond portfolio, you're probably only averaging 2 or 3% on it anyway, because you already bought a lot of those bonds years ago, and you're probably not making a ton of money with bonds. If you want to make 5% on a bond and buy an ETF of corporate bonds that average about 5% dividend, but if interest rates go up a point, you might lose 10 or 20% on that bond portfolio if you have to sell out over time and use that money. So you have to be careful about bonds even as a safe haven. Borrowing becomes more expensive. If you're not comfortable paying 6 or 7% to buy a car, then maybe you pull money out of your savings. Maybe a 401k or IRA that's taxable, you lose 30% off the top, depending on what tax bracket you're in, and then you buy that car to save 7%, and then you don't make any money on that investment. But then again, if the market crashes, you'll be happy you did. I mean, there's just so many what ifs that sometimes make us make interesting decisions when interest rates are high. Bond rates are a little high, bonds are going down, not necessarily the safe haven they used to be. CDs don't pay enough to jump into there. So we might go all in stocks, which are more vulnerable in high inflation times in a higher rate environment. So again, there's a lot of different ways to skin the cat. Diversified portfolio does not mean just 150 different stocks and bonds. A diversified portfolio means you have money at risk that you try to swing and get more than hits. You want to get doubles, triples, and you want to hit some home runs with your market money. That's what it's there for. It's to buffer the rest of your safe money that might be keeping up with inflation or doing a little bit better. But that long-term growth on the market money is what really helps us down the road over decades to combat inflation. Usually when there's inflation, it hits the highest, the market isn't doing as well. So we hope we've already made money in the prior good years when inflation's been in check, when the market zooms, and we want to be locking in profits along the way to cover those times. They never seem to happen in sync. And that's what I think there's a disconnect with most people. Is like, well, there's inflation. Why aren't we making more money on this? Or why can't we get more interest on that? Well, during inflationary times, it doesn't always go in sync. We have to kind of ride them out. And hopefully we've done well in the prior cycle. And hopefully we'll do well in the next cycle to where we can kind of even out that inflation roller coaster ride that we really haven't been on an inflation roller coaster ride until lately, but it's really not that bad of a ride other than the first few years of Biden. That wasn't good. It's been a little more in check, a little more tolerable, a little more reasonable, and at least interest rates have been keeping up pretty much generally in sync with it. So for now, it doesn't look like it's hurting us. Yeah, I don't know. If this war causes inflation and there's more pressure on the Fed to keep interest rates high or raise interest rates, then I think we're going to see some harder times ahead. I think America's in a place in general where even though there's tough times for some people and maybe our kids are struggling more than we wish they were, and if we look back, probably not even close to what we did during that same age period, We're just doing so much better off. We have a higher level of expectations. So I don't think anything that we're seeing right now is, if you have the right plan or if you have the right perspective on it, is going to derail the American dream or the ability to retire on your terms or to have as much income as you need to do fun stuff and to pay your bills and to enjoy life, not just get by. So again, sometimes maybe we have to just see things through the eyes of reality and make adjustments, not be overly thinking everything or being too cautious because then you don't have any fun, but also not being too aggressive, because a big loss, if you're super aggressive, might be more devastating than you think, and you only find out about it after the fact. So again, if you can jump on a boat where you have a skipper that sailed the waters you're in before, you probably have a better chance than if you rent a boat and go out there the first time on your own. And I say that because it's an analogy of retirees. Many of them have never done a retirement plan. They never retired before. Most people haven't. And they decide to just go rent the boat and sail off into the retirement waters alone, not knowing what options there were for safety, not knowing where the life jackets are, not knowing where the rocks that they didn't want to hit are, not knowing where the lighthouse is that they need to look at for direction and other things. And then they wing it and end up making mistakes and finding out the boat doesn't work, or they hit a rock and sink or whatever. We've been sailing these waters in retirement for 40 years now. Crazy to think that. And the first 20 was kind of finding out where everything was. And the last 20 has been pretty good. We know where to take the turns and where not to go. And when the seas look crazy and wavy and rough, we don't go out there. We stay near the shore. We stay near where it's safe. So again, there's ways to think about retirement. If you make that analogy work, just make sure that you're safe. Make sure that, like I say, if you're not driving your boat alone, get somebody that's driven it before and knows where they're going.
Jeff, let's bring it all together for our listeners here. What should retirees be thinking about right now?
I don't know. There's a lot of things they should be thinking about right now. And one is my plan intact? Is it working? Have I had a review in a while? Is my risk in line with my risk tolerance? Am I subject to having to change my lifestyle if the market does a big correction? These are things that we talk about every week and that people should have already been thinking about. This isn't anything new. I'll just say, if you fail to plan, you probably plan to fail at some point. You might have gotten lucky the last 5 years or decade or so, but that doesn't mean you will forever. And in a 30-year retirement, there's bound to be some bad times. So make sure that you hope for the best, plan for the best, but also plan for the worst at least, even though we don't plan on any of that stuff to happen. The fact is life happens. Life is unknown. Nobody has a crystal ball into the future. We just have 20/20 hindsight. And 20/20 hindsight for us is, let's look at history and see what's happened in the past and know that it could happen again. The sequence of returns might not be in your favor. You might be retiring at a time when the market's at an all-time high just to go into a crash. I've talked about the story about Norm, who did that in 2000 and ran out of money in 9 or 10 years and wouldn't have if he'd have, retired with that same $1 million 3 years later, because he'd been at the bottom of the market. But the thing is he would have had to do something not to ride it down to the bottom to protect those losses along the way. So again, remember, you never get hurt taking a profit. You only get hurt making losses. The only way you lose money is to sell lower than you buy it, right? Or to sell lower than you could have if you would have taken it out of the risk bucket and into the safe bucket. So again, keep that in mind. Make sure your plan, it looks forward. We like to look forward decades until people are at least 100 years old, even if you're only in your 50s. We want to look that far down the road to make sure that what you do now is reasonable and not going to affect you in a bad way long term.
Great conversation, Jeff. I want to talk to our listeners right now. If you're within 5 to 10 years of retirement or you're already retired, this is not the time to guess. You need a plan that clearly shows how you can preserve your wealth, how to create an income stream that you can't outlive, and how to reduce taxes. That's exactly what the Retirement Roadmap does here at Premier Retirement. If you would like to get yours at no cost and no obligation, call 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you. Again, it's not going to cost you a dime. 520-780-9059. We're also online at premret.com, PREMRET.com. Ask for your no-cost Premier Retirement Roadmap. Jeff, time for a break. When we come back here on Premier Retirement, we're going to be answering listener questions. And then later on, we're going to be talking about whether or not there's a real magic number to retire comfortably when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for joining us. We're here for you each and every week with Premier Retirement for your fiscal fitness and your financial education. Once again, our phone number 520-780-9059 if you would like your Premier Retirement Roadmap at no cost and no obligation. By the way, we're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and Sundays at 11 a.m., and 24 hours a day, 7 days a week. We're also online with our podcast. Go to wherever you get your podcast. You'll find our show there, or you can simply Google Premier Retirement with Jeff Vogan, and you'll find all of our shows right there. Okay, Jeff, these are the kinds of questions we hear every week. People who've done a great job saving, but now they're asking, what do I do with that money? So let's dive in right now with this week's listener questions. Glenn's listening to us in Vail, and Glenn says, my portfolio has a value of around $4 million. It has done well, but it's very stock heavy, 70%. I'm 63 now and want to retire at 67. When should I start repositioning for retirement income, and what do you suggest?
Well, you've done well to save $4 million. Most people who have kind of at your age range, I kind of look at a situation where $4 million, if you've been able to save $4 million, you probably made in the $300,000 or $400,000 range in income potentially, or you underlived your means by a significant margin. You probably want to continue to keep that maybe $250,000 a year type of lifestyle. You could, with about half of that right now at 63, with about half of that, you could take profits off the table, go into principal protected assets, and be guaranteed about that $250,000 a year lifestyle between income, assuming these are mostly IRAs, that would be taxable income, but would supplement your Social Security significantly. You'd also probably be in that IRMA level where you pay a little bit more in taxes. You'd also have another couple $1 million, depending on how much of it is Roth or how much you're willing to pay taxes on over the next 5 years in order to have a much more tax favorable retirement. But, if you're 5 years away from retirement, if you use the 4% rule, just say there's a stock market crash, it takes 5 years to get back to even, and you still have $4 million. The 4% rule at Wall Street says you should live on $160,000 a year. Well, I can show you that on a half or just a little bit more than half of that money, you could be guaranteed that for life and not have to ever touch the other half, roughly. And that would be easy to do. But of course, Wall Street doesn't want you to know the tools that everybody else has, everybody who's a registered investment advisor that is licensed in both insured secured products for retirement as well as the risk on, risk off type products of securities. It's funny they call securities anything with risk, securities, stocks and bonds, they can all go down. But bottom line is you're in an easy situation to look forward to a nice, happy, healthy retirement if those income levels that I just mentioned are suitable. Most people, if they've been able to save that much, probably don't have a whole lot of debt. Maybe you got a nice little real estate portfolio. I don't know if that's all cash or stocks, bonds, whatever. You say very stock heavy, 70%. That's probably a little bit more than you need. I think it's probably how you got that $4 million is by taking some risk and being aggressive and growing your wealth. And you've probably done very well doing that. So good for you. You never get hurt taking profits off the table. One other strategy that I would say, in addition to possibly, depending on how you're cruising into retirement, if you're at your top of your income levels, you might be topping out your 22 or 24% tax brackets already. So you might not want to do Roth conversions now. You might want to do them later. Or if maybe $1 million of your portfolio is not in IRAs, you could start funneling some of that money into LIRPs, life insurance retirement plans, which are not only tax-free, provide tax-free income, they provide a death benefit, which can be used for long-term care or terminal illness later, can also be used as a non-1099 generating income source that never looks like provisional income because it's not income. It's just a loan against your death benefit, essentially. It's basically a tax-free loan against your death benefit that doesn't even have to be paid back till you die with your death benefit. So you can use a bunch of that money while you live. That's why I call it life insurance. The other one I think is death insurance, where you buy a policy to make someone else rich when you die. But you ought to consider maybe looking at how a LIRP might add some value to your plans. It might be smart to try to invest, at least max out your 24% tax bracket right now and do some Roth conversions or LIRP conversions and transferring some money and going ahead and paying those taxes at 24%, because a $4 million asset growing by the time you're 73 or 75, if you're 63, you're the same age as I am. So you're not going to have to take your RMDs, required minimum distributions, out till you're 75, which gives you more than 10 years of growth. Let's just say at market averages, even 7, you're up to $8 million. And now you've got to take $300,000 or $400,000 out of that account every year if it's all IRA money, and you're going to be in the top tax bracket forever. So my opinion would be as aggressive as you can between now and the age 75 in paying taxes now on as much of that money as you can at 24% instead of going into the 30 or 40% tax bracket. And I really think, and by the way, that might probably save you and your family another $1 million or more in taxes or money that you can give to your heirs instead of give to the IRS. And I believe your heirs will spend that money, even if they blow through it, more wisely than the government, who blows through our tax dollars without any reservation or any conscience. So again, I like doing the tax plan. I think that's probably your biggest hurdle that you don't maybe see readily right now, but you're going to have to address eventually, and you might want to start addressing it now. So that's why we include tax planning as part of any reallocation of assets. But never hurt you to take profits, never hurt you to do some tax planning and get some tax-free income for the future, and to guarantee that income so that you're not going to miss a beat, not going to miss a paycheck, and be able to retire on the same standard as you are while you're making a good living right now.
Glenn, good question. Thanks for listening to us in Vail. And again, if you'd like to further the conversation with Jeff, 520-780-9059 is the number, 520-780-9059. Okay, Jeff, Steve's hearing us in Alta Vista. Steve says, my wife and I have saved about $1.8 million, but most of it is in IRAs and 401ks. We're both 60 and want to retire at 65. How worried should we be about the tax hit when we start withdrawing?
Well, yeah, I don't know what your other income sources are. If you've got IRAs and 401ks, obviously that's a taxable event. But if you're going to start using that money in age 65, when you get on Medicare and when you have Social Security, let's say your Social Security's $50,000 or so, let's just say conservatively, because there might be a little correction along the way or some choppy markets. Let's say it's worth $2 million. That'd probably be worth a little bit more than that, maybe $2.5 million. You're going to have to pull out about $100,000 a year out of that when you're 73 to 75 anyway. You might want to start thinking about using that right now. But if you converted some of that money into guaranteed income, let's say $100,000 a year, and then you had a $25,000, maybe $25,000 each on Social Security, I'm just guessing there, so maybe $150,000 income. By the time you write off standard deductions and some of the non-taxable portions and credits for Social Security, you're going to be down to almost a 12% bracket. So I don't know that while you're working right now, because I'm guessing you're definitely well into the six-figure range income-wise, at your highest earning years that you've been in a long time, you probably don't want to do a lot of taxable contributions right now. You probably need the tax deduction, because I think you're in a place where if you want to be conservative but have a guaranteed mid-six-figure income, 150 or so, I think that's easily attainable without really going into more than a 22 or 25 or possibly what's now the 24 bracket, which might return to 28 bracket. But I don't think you'll have to if you want to live on a nice steady income. Maybe what you do is as soon as you quit working when you're 65 is you take a nice income that's comfortable and use the rest of whatever tax bracket you're in. Hopefully it's in the 12. I don't know if you can get much out of that, but maybe move the rest at a 22% bracket into Roth IRAs or LERPs or something that will never be taxed again, but will always be there that you can dip into without going into a new tax bracket later. So I look at these numbers and I say, well, that's an easy plan. If you're going to use that money, probably not going to be as big a deal as somebody who's got 4 million, like the last question, who's not going to touch it for 5 years, who's a little older, a little bit closer to that RMD age. So again, I think you can live on a very nice living. I think you can stay out of the higher tax brackets and at least even stay under that IRMA level if you're okay being conservative. But then again, if you're not conservative, you swing for the fences, you make a ton of money, you pay more taxes, but you make a ton of money. If you swing for the fences and the market crashes, then you lose a ton of money, then you live on less and you don't pay taxes. What's the better trade? I think a nice balance between growth that doesn't get you into tax trouble, guaranteed income that doesn't derail your retirement plan is probably the best course of action. And that's how we build our plan. So if you want to come in and look at it, happy to see you guys and walk you through how our happy clients are dealing with their money when they're 65.
Steve, thanks for listening to us in Alta Vista. And once again, you can call Jeff at 520-780-9059 and continue this conversation. Next question, Jeff, is Mike listening to us in Ventana Canyon. And Mike says, a big portion of my net worth is in real estate here in Tucson. It's about $4 million, and it is in apartments and storage units. Should we be thinking about selling or diversifying before retirement?
I don't know. I think it depends on how hands-on you are. Do you like managing property or somebody else managing it for you? Is it a cash flowing? Are the apartments and storage units old? Are they in places that used to be really nice, but now are turning a little more ghetto, pardon the expression? But I mean, some older neighborhoods are great places to own rental properties, but then you've got that deferred maintenance that comes in, might kick your butt. Then you've got maybe the rental market in those areas are getting a bit less desirable as far as the renters that you can attract, whether it be storage units or apartment complexes. But there are a lot of movement into the apartment world right now with investors that expect to make a ton of money on the baby boomer kids that don't want to buy houses because they don't want to be stuck somewhere. They don't want to be paying the taxes and be burdened with the repairs and all that stuff. And they kind of like the apartment lifestyle, the renting and the footloose and fancy free lifestyle, especially if they're not planning on having kids and things like that. So I think the apartment business is probably not a bad way to think of the future as a pretty solid way to make a living. However, if you're just looking at income that's totally passive, you don't have to worry about midnight moves and filling your house and painting it or deciding what to spend money on and when to fix this and when to fix that, and you want to go into retirement and not worry about stuff like that, there are other ways to create income and probably still leave your kids a few $1 million in death benefits and maybe hassle-free asset transfer if you want to do it that way. I've talked to people. I had a client that had $10 million in real estate, mostly strip malls and retail stuff, and was netting probably after expenses and everything. Plus, he had a management company doing a lot of stuff, netting about $250,000 a year. Well, we created a situation where his kids would get no less than $10 million. It would be tax-free, and he'd get to live on $400,000 a year, and most of that tax-free money, by the way, and not have to worry about all those hassles with rental. So there might be some options to look at going ahead and just selling some of that, paying the taxes on it at 15 or 20%, depending on how fast you get out of it. Probably 20% if you get out of it in big chunks. But that's still cheaper than ordinary income taxes are on the income that you get out of a 401k. So I would look at some options, maybe sell the problem properties, keep a little bit of them that are easy cash flow. I know people that storage units are probably the easiest one to have security. I mean, if somebody's late on their rent, you just put a lock on there and say, hey, we're going to take your stuff if you don't pay us. And there's some security there, and storage stuff doesn't necessarily trash your apartment and cause you big bills like some bad tenants do. So again, there's just all kinds of options. I'm not telling you to keep or sell your property, but if you're asking the questions, I'm thinking you're a little bit nervous about maybe the time that it takes. And right now it's probably a second job if it's not your primary business, unless you are the manager. And if you are, maybe you're getting burnt out and you want a little bit more free time and more that footloose and fancy-free lifestyle. And if you do, then maybe you just need to transfer those assets to income-generating assets that you don't have to worry about.
Mike, appreciate you listening to us in Ventana Canyon. And once again, if you would like to continue this conversation with Jeff, the number to call, 520-780-9059. It's 520-780-9059. You can also find out more about us online at primret.com. It's primret.com. And if anyone listening to us today would like to get their Premier Retirement Roadmap, you can get it at no cost and no obligation. It's 520-780-9059. You can make that call right now if you want. Leave your name, telephone number, and Shelley will call you back during the week and set up that appointment for you for a one-on-one conversation with Jeff. Again, it's 520-780-9059. You can also find out more about us online at primret.com. Jeff, recently in this month, actually, Northwestern Mutual released its 2026 Planning and Progress Study, finding that Americans believe that they need a magic number of about $1.46 million to retire comfortably. And for high net worth individuals, they're finding that people think that they need $2.6 million.
You know, I think rules of thumb are kind of crazy. Everybody's situation is a little bit different. I mean, if your lifestyle requires a lot of travel, high-end entertainment, things like that, you might need more than $2.6 million. If you live the modest lifestyle and are happy gardening and watching TV in retirement and don't like to travel because you're scared of flying or driving and just want to be a homebody, you could probably do it on Social Security paycheck and no savings. So anywhere in between that, it's funny that I have people that kind of have maybe unrealistic ideas about how much, say, $400,000 will generate. I had a lady come in one time, and I may have used this example before. She wanted $60,000 a year to make up for her husband who had just passed away, lost some Social Security, and needed $60,000 to maintain their lifestyle. Well, the bottom line is they were burning through their money anyway. And she says, well, I have $400,000. That's a lot of money. I said, well, not if you want $60,000 a year off of. That's talking 15% withdrawal rate. I don't know any asset that can guarantee that kind of a withdrawal rate, even if the average rate of return on that asset is more than that, because it still has volatility and you're still going to lose money. And other people have $3 million and they're scared to spend $30,000 a year, which is like 1% withdrawal rate. And you can do that in a money market account without drawing it down. So it's kind of interesting. You get the two sides that are just a little bit way too either fanatic, what would you call it, overzealous in their thinking on either what their money will provide or thinking that the risks are way too high to risk it. There is a happy medium place. What we do with a plan is we say, this is your net worth. How much would you like to live on? And let's build a plan that will afford you that lifestyle. The 1.4 million nationally is probably somebody that wants to live on about a total income of about $100,000. And that is assuming that $1.4 million is invested in the stock market and you're using the 4% rule, which has actually been outdated after the lost decade of 2000 to 2010. And even a few glitchy years between the COVID hiccup and the 2022 and, Biden decided inflation was okay. But the truth is everybody's got a different standard, a different style of living, and the ability to make adjustments. There are people that come in that are making a lot of money that have never learned how to save and they know that they're not going to have that same lifestyle and they need to make an adjustment. So we'll take the assets they do have, put them on a saving plan or some sort of a spending plan, either to get out of debt or to reduce their cash flow needs so that they can live on what they have. Or we'll say, hey, look, if you retire at 65, I hope you can live on $7,000 spendable a month. If you can't, then you need to work longer. At least coming in pre-retirement is going to give you an idea or some sort of a focus on that. Or I have $1.4 million, but it's all in the market. So I can live on $60,000 from that and another $50,000 from my Social Security minus $10,000 or $11,000 in taxes, leaves me about $100,000. That's about $8,000 or $9,000 a month. I think I could do that. Well, what if you took that $1.4 million and guaranteed yourself $120,000 a year in income and still had $400,000 of it to invest in the market, or put it in a LRP where you had a tax-free bucket that you could grab a couple $100,000 out of if you needed to on a tax-free basis if you needed it, or maybe $30,000 a month or something like that. So you could actually probably bump your lifestyle if you wanted to structure it correctly more to maybe 30 or 40 or 50% higher than this Wall Street model. And I think the reason that they say these big numbers, I think it's really self-serving. Wall Street makes money on fees and transactions. They make money by having you keep all your money in stocks and bonds. They say, well, there's a 4% rule. So if you want to live on 100 grand, you better have 1.4 million, and you got to keep saving. You got to keep putting in these accounts that have fees, whether it's mutual funds or brokerage fees or advisor fees or whatever. Is they want you to keep more and more money, or at least acquire more and more money in those accounts, because they're scaring you into believing that you need 1.4 million to retire on $100,000 a year, where you might only need 600,000 or 700,000 if you position it right and you lock it in for guaranteed income instead of try to take risks with it in the market and deal with Fed interest rate hikes and decreases and all the things that you don't control. 2.6 million for high net worth folks. I know some high net worth folks that can't live on that. I mean, Elon Musk, I don't think could live on that in a month. What's a high net worth folk? Is it somebody that just has more than a couple $1 million? I mean, is a high net worth somebody with over 2.5 million? Well, that's the definition of high net worth. Oh, you have 2.6 million. They need at least 2.6 million. I don't think you're even considered a high net worth folks if you're not over 2.5 million or 3 million or 5 million. So I don't even know why they put that stat in there. I think it's just interesting. If somebody wants to be hey, I'm a high net worth guy, I can live on $200,000 a year or $150,000 a year instead of only 100, like my friends that only have 1.4 million. Look at me. My opinion on 2.6 million, you ought to be able to get 7 or 8% of that, probably more like a $200,000 plus lifestyle out of 2.6 million if you want it, and if you're willing to be a little more conservative in the way you structure your assets, and if you want to be more income focused and tax efficient focused rather than growth focused, because you want to be worth $10 million when you die. You better not spend the 4% rule. You want to spend less. You want to keep on growing it, and you want to keep on being aggressive, but you better not be needing that money to live on for now in the next few decades. So again, everybody's got a different perspective. Maybe you've got pensions that cover all the bills. In that case, you don't need 2.6 million. You don't need anything because you've got a bunch of pensions. If you have no pensions, maybe the 1.4 million isn't enough if you have horrible Social Security, or if you were self-employed and never paid into Social Security because you used an S corp because your accountant said it was a good tax strategy, and now you find out it's not a good tax strategy. It's a great tax strategy, but it's a horrible retirement strategy, and now you don't have any money. So you need that asset to live on. Maybe you need all of it, and maybe in that case you need all of it to be focused and repositioned and to create income because you have no other sources. Again, there is no rule of thumb. Everything is an it depends answer. Your situation is different. And that's why working with a fiduciary, I think it's funny. People call themselves fiduciaries and they end up doing the same exact thing for everybody. It's the same portfolio, same mix, and the same story up and down. A fiduciary had to work with you based on your goals, what you have to work with, what your income levels are, what your tax strategies are, how much money you have, how much debt you have, what your cash flow needs are, whether you have a legacy, whether you have kids that need to be taken care of, and so many things that these people on TV that we're a fiduciary, we build long-term accounts, come see our portfolio. We don't sell commission products. We just charge a fee forever. When we do better, you do better. And when you do worse, we still make money. Is that really the definition of a fiduciary? I don't think so. I think the definition of a fiduciary is, what do you need? It depends. Let's hear your story. Let's hear what you want. Let's use all the tools in the bag. Let's secure some of it for income. Let's make a tax plan that's relevant. These other people that throw that word loosely around as fiduciary don't even do tax planning. They'll go ask your accountant, and your accountant just says, well, don't spend it now. Kick the can down the road. We want to get as many deductions as we can this year so that I can have your business next year. And that's not all accountants, but many of them. I don't mean to offend any of you listening that are a good accountant that actually looks forward and does a good job at that. But too many are just all about last year and not about next year, other than how much quarterlies you need to pay so that they don't have to give you bad news next time you owe money. So again, to pick a number is ridiculous. To pick a lifestyle number, maybe I need $140,000 a month to live on. How do I get there? Or do I have enough to retire now and get there? Or do I need to work a little bit longer? That might be the better question.
Jeff, when I go to Fry's Supermarket, I look at the license plates. I see them from Washington, probably Seattle. I see them from Illinois, more than likely Chicago, and I see them from many other parts of the country, California, Los Angeles. Is retirement here in Tucson different than the national averages?
Well, I think Arizona in general is different than national because a lot of affluent people come here because they can afford two homes, a winter home and their summer home back home where it's cool. So we do get that. And I think the unfortunate part of that is when affluent people come here and they have enough money to buy a second home and maybe drive the supply down a little bit and increase the demand, it creates a little bit more pressure on pricing so that the typical retiree that maybe is from here that can't afford two houses has a little bit bigger problem buying a new place if they need it. However, on the flip side is if they do want to sell and downsize, maybe the fact that out-of-staters have bid up the price of Arizona homes to a level that they can actually make a little bit extra. So there is that. I think there's a certain, I want to be like the Joneses type lifestyle. I think the fact that Arizona has been a reasonably affordable place to move to from any state. We get a lot of people from like Seattle, which is pretty high priced real estate. You get California, no matter where you live there, it's high price. So they come here with a lot of extra money and are willing to buy things. They create a lot of economy, which is good. But I don't think that if I was sitting in California or sitting in Seattle or sitting in Chicago or New York or anywhere, that I'd be designing a plan any differently other than the fact that we'd have to take into account taxes, cost of housing, different costs. Maybe you need a higher number to live on. Maybe if you live in those states and want to stay there year round, you might have a hard time having that second home in Arizona. Maybe it would be better to move to Arizona like so many people do, take some cash off the table and use it for extra income so you can golf and play and do more stuff. So I don't know that it's any different here as far as the planning goes. I think there's certain things that being a retirement community affects. It does mean that there's going to be consistent growth, I believe. There's going to be a lot of consistent infrastructure, new neighborhoods, new stores, new shopping centers, more crowded roads for sure, and hopefully new roads that'll help us get around better. I haven't really thought about whether people are at an advantage or disadvantage to retire here as opposed to somebody else. If they want to retire here, we'll just make the most of their money here. And knowing how things work is really all you have to work with is, what are my rules? What's going on in Tucson? How do we make it work the best here based on maybe a little bit higher property taxes, but maybe a little bit lower something else? As long as you know the rules that you're playing with, then you could probably live and make a retirement plan for anywhere. Now, I'd hate to do it, in some really high tax areas. We'd have to be real aggressive with tax planning in New York or California, and you probably want to have a little bit more savings or some extra income or some source of wealth to afford to stay there compared to maybe a little bit lower threshold lifestyle state like Arizona. So again, and I don't know that it's a huge difference, but where somebody lives on $100,000 in California, they might be able to do it on 75 or 80 here. So is that a big deal? Well, maybe not if you really like the lifestyle, and you'd be spending that much money on golf here anyway, and out there you can go sit on the beach for free. I don't know, what are you trading by coming here? I guess that all remains to be seen and depends on where you come from on whether you notice a difference. But I don't really notice a difference. I have probably half my clients that are all retired, probably close to that, live somewhere else, at least part-time during the year. And some of it is maybe in the mountains here in Arizona, second home, but a lot of it might be New Mexico, Iowa, Colorado, Oregon, Washington, whatever. And we just have to make sure that we know the rules in both states and that we know we're making the right decisions, that if something bad happens in one of those states or the other, you at least have options, and to make sure that we're accounting for those things in a plan so that you don't have to make hard decisions down the road and have to give up your lifestyle if things don't work out.
Well, Jeff, I think the takeaway from our conversation here is that the magic number is almost irrelevant, and this is where people need help. They're hearing these big numbers, and they're worried that they're behind. So if you're listening right now and you're wondering, do I actually have enough? Don't guess, get a plan. At Premier Retirement, we'll build you a custom retirement roadmap that shows you how much income you can generate, how long your money's going to last, and how to reduce taxes. It's not just a generic number, it's your plan. So if you'd like that, call 520-780-9059. No cost, no obligation for this, 520-780-9059. We're also online at primret.com. And remember, there is absolutely no cost and no obligation. Well, Jeff, we're out of time for this week. I'm going to thank you for your time, but most importantly, as I do every week, I want to thank our fine citizens here of Tucson for joining us. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.